Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. Alibaba Group embodied China's economic miracle, sustaining a dizzying pace of growth and approaching trillion-dollar valuations with splashy forays into every corner of the internet. That spectacular run could officially end this month, when the e-commerce powerhouse that Jack Ma founded is expected to record its first ever decline in quarterly revenue, one of the few major Chinese internet corporations to do so ever. But before we get started, please smash that like button so others can find this video as well. Let's continue. This milestone of first ever quarterly decline in revenue is a reminder for investors that after a government crackdown that wiped more than $1 trillion off their combined market value in 2021, Alibaba is just a shadow of its former self. Like the rest of China, they're grappling not just with an uncertain regime, but also COVID-0 and a consumer crisis that's testing the stability of the world's number 2 economy. It should not be surprising that the second quarter of 2022 will be one of the worst quarters since the pandemic for China earnings, given the lockdowns, and tech companies are no exception. Tech has also faced additional regulatory headwinds on growth prospects, which is more structural and long-term trend. The speed and ferocity with which Beijing clamped down on online commerce, car sharing, food delivery, and gaming irrevocably reset growth expectations for the industry last year. But Alibaba has taken a harder hit than many of its peers. Alibaba has been dealing with one bad news after another. First, there was the tax evasion probe into celebrity live streamer Via, who once single-handedly moved $1.2 billion of goods during Alibaba's November 11th online bonanza. Then, the nation's technology watchdog suspended ties with its cloud business for late disclosure of a major software vulnerability, spooking potential clients. In June, lipstick king Li Jiaqi became the second major personality to vanish from Alibaba's Taobao after apparently offending censors. And just last month, cybersecurity experts linked AliCloud to China's largest cybersecurity breach, a leak of records on 1 billion residents from Shanghai's police database. All that transpired as China narrowly escaped economic contraction in the second quarter when rolling COVID lockdowns depressed spending on everything from online content to apparel and electronics. Once candidates to join the likes of Apple Incorporated and Amazon.com Incorporated in a select club of companies with trillion-dollar valuations, China's largest internet companies are now struggling to keep up with even the lowest expectations. It used to be the case where investors bought Alibaba and Tencent shares hoping their dominant positions in e-commerce, social and gaming would create synergy with their newer businesses and vast swathes of portfolio firms. But that's a long-lost cause since the government tightening. Market sentiment toward Chinese tech stocks swung wildly in recent weeks, reflecting a persistent struggle to juggle a torrent of negative signals with expectations that Beijing is finally easing up on its crackdown. Alibaba rose as much as 25% in June and July after some positive news, including its decision to apply for a primary listing in Hong Kong that paves the way for millions of mainland investors to directly buy the stock. It surrendered those gains within days as investors assessed the implications of co-founder Jack Ma ceding control of Ant. Then, Alibaba became the latest to join a growing roster of Chinese firms that face removal from US bourses because of Beijing's refusal to permit American officials to review their auditors' work. Chinese tech executives have warned investors repeatedly to prepare for a new reality of lower growth, but the downbeat projections paint a gloomier picture than many feared. As COVID lockdowns paralyze business activities in cities such as Shanghai, China's once reliable economic engine has lost steam. Even Alibaba's cloud division is flagging. Its revenue is projected to expand 14.3% during the April to June period, but that's the second lowest number in about 6 years. The worst should be behind us as the economy picks up pace and lockdowns ease, but it may be a bumpy recovery depending on the COVID situation. So that's it from us, everyone. Be sure to smash that like button and let us know which company you want us to cover next. Thanks for watching and subscribe for more.